So, you'd like to know how a project finance model fits together. Hello, I'm Kyle, and welcome to Finmodo. My aim in this tutorial is to help you to see the matrix in project finance modeling. Today's learning objectives are to understand the distinctive features of a project finance model and how this drives complexity. To break down the anatomy of a project finance model. How does this fit in the learning journey? This time, you're getting an overview of the model. Firstly, let's talk briefly about the distinctive features of a project finance model. We're talking about large projects, typically infrastructure like a toll road. Who funds the construction? Well, simplistically, debt and equity. And then the project is operated, producing cash to the funders through debt service and distributions. Now, as you'll know, there are a number of differences for the treatment of debt and equity. Of course, debt has priority over getting paid back. So this is reflected in numerous ways. The most obvious being that they are higher in the hierarchy for cash flows, i.e., principal and interest payments are senior to distributions, which ensures debt gets paid back for that specific period. But what if cash flows take an unexpected dive, and the cash flow available for debt service in that period is not enough to cover the debt service? What can lenders do to ensure they get paid? They can reserve cash from the cash flow in excess of debt service in advance, or they can get funds from the construction funding. Thus, we often see reserve accounts which reserve cash for things like a lack of debt service reserve account, or periods of capital expenditure on maintaining the assets, major maintenance reserve account. These reserve accounts also take precedence over cash flows to equity, which means that the funding to these accounts is higher up in the cash flow. Another distinctive feature of a PF model is in debt sizing. There is some complexity around here because lenders charge interest and fees on the debt. However, there are no cash flows to pay these financing costs during construction. To prevent these from being unfunded, the project needs to take on more debt and equity. The additional debt taken on generates additional financing cost, resulting in more debt and equity that needs to be taken on, and so on and so forth. This right here is called a circularity and is an iterative process to solve. To be in control of this and a few other issues, we need to use macros. Okay, so that's a couple of distinctive features of a PF model. Next, let's look at the anatomy of a model that these features we've discussed give rise to. This is a simplified representation of a project finance model structure. First things first, the input sheet. It's self-explanatory, and to be clear, there should be no inputs on any other sheets. The timing sheet is where the date bar is calculated at the top of the sheet, in addition to counters, which are the intermediate calculations, for example, year of operation, that are actually needed to use in the call-up or reference formulas at the top of the sheets. We've already discussed construction. This tab involves the calculation of uses and sources during construction. We've touched upon circularities, which give rise to the need for macros, i.e. VBA, the Excel interface to which we house in the macro sheet. Now, many people hate macros, and for good reason. They've typically been done really poorly, which has resulted in non-transparent models and headaches for everyone. Now, if these are done really well, then they help the model to actually function smoothly. Operations. Here is where the revenue generated and the expenses incurred during operation are calculated. We also adjust the calculations from an accrual basis to a cash basis with working capital calculations. We've partly touched on the debt tab. This is where your debt service is calculated for all facilities and all tranches of debt, where the DSRA is calculated, debt metrics, and a few other things. And now to everyone's favorite. What about tax? The D&T tab is where tax is calculated, in addition to depreciation. Tax is calculated based off the P&L, or income statement. EBITDA, less tax depreciation, less interest, less adjustments for tax losses. And this feeds into above the cash flow available for debt service. So, can you see how the P&L expense gives rise to a cash item? Next up, depreciation. Firstly, what are we depreciating? Well, of course, the assets of the project, which typically includes the financing costs which go into producing the asset. Why is depreciation important to calculate in a project finance model? Sometimes you'll see project finance models as just cash models. Well, it's important because this impacts your taxable income, which impacts your amount of tax actually paid, which shows up here on the cash flow waterfall. Make sense? Now, equity is where your distributions to sponsors are calculated, in addition to cash returns to equity and to the project, and the calculations of financial metrics like the internal rate of return and net present value. So, this is a section of the model where the sponsors will be very interested in. The financial statements is where everything ties together in the cash flow waterfall, profit and loss or income statement, and the balance sheet. The cash flow waterfall is where CFADs and cash flow available for equity and other cash flow items are generally calculated. So as you can imagine, there are many linkages coming back out of the sheet. I've listed a few here, for example. Moving on, scenarios is where the scenario manager and data table are housed. This is a key feature of the model, which allows sensitivities to be run, and it really is the brain of the model. You can include a summary for key information, and there are a few other technical sheets which we won't cover here. Now, the structure changes slightly when you need to consider multiple assets, or if you have to incorporate historical information into the model, i.e. actuals. So that's the basic structure of a project finance model, and gives you a fantastic overview of the distinctive features and how this all fits together. To get the template to one of these models and training on how it all works, sign up to the Project Finance Blueprint. And hopefully you liked this tutorial. If you did, feel free to check out more tutorials on finmodo.com or sign up to our newsletter. See you on the next tutorial.